Do you know where you are financially? If not, it's time to figure out your starting point. Just as a map helps you navigate unfamiliar terrain, understanding your financial situation can guide you towards your financial goals. One of the most effective ways to do this is by creating a personal financial statement. A personal financial statement is an honest inventory of your financial health. It's like a mirror reflecting your monetary reality, allowing you to clearly see your assets, liabilities, income, and expenses. The two most crucial components of this statement are the income statement and the balance sheet. Let's talk about the income statement first. Sometimes called a profit and loss statement, it measures your income and expenses. It's divided into two sections. The top half lists 3 types of income: earned, passive, and portfolio. The bottom half lists your expenses, like mortgage or rent, phone bills, food, and more. Preparing an income statement regularly, say every few months, is a great way to track your financial progress. It begins with the gross income, which is the money you earn from a job, business, or investment, and ends with the net income, which is what's left after deducting all your expenses. Now, let's move on to the balance sheet. This document is divided into 2 columns. One lists your assets, while the other lists your liabilities. It's a snapshot of how much money you have, how much money you owe, and the difference between the two at a given moment. From the balance sheet, you can determine your net worth, which is the difference between your total assets and total liabilities. Understanding these 2 documents and their interplay is like having a master key to financial freedom. It's the first step towards achieving your financial goals and getting out of the so-called rat race. Remember, knowing your financial status is like having a map. It helps you navigate towards your financial goals. In the next scene, we'll delve deeper into assets, liabilities, and net worth. Stay tuned! Now that you understand the basics of a personal financial statement, let's delve into the details of assets and liabilities. An asset isn't just something you own, it's something that puts money into your pocket. Think of it as a helpful friend who gives you a little cash from time to time. It could be a rental property generating monthly income, a business you've invested in that yields annual returns, or a stock that pays dividends. The key feature of an asset is that it provides a positive cash flow. On the flip side, a liability is like that friend who always seems to need to borrow money, draining your wallet. Liabilities take money out of your pocket. If you stopped working today, your car would still require monthly payments, gas, maintenance, and insurance. Your home would still demand mortgage payments, property taxes, insurance, and upkeep. These all generate negative cash flow and are hence liabilities. So why are these terms important? Well, they directly impact your financial status. Your assets contribute to your wealth, while your liabilities chip away at it. The balance between the two paints a picture of your financial health. Now this brings us to a critical term: net worth. This isn't some highfalutin concept reserved for the rich and famous. It's a simple calculation that gives you a snapshot of your financial standing. Your net worth is the difference between your total assets and your total liabilities. It's what you have minus what you owe. In mathematical terms, net worth equals assets minus liabilities. If you have more assets than liabilities, you have a positive net worth. But if your liabilities outweigh your assets, you're in the negative. Knowing your net worth is like having a financial GPS. It shows where you are now and helps chart a course to where you want to be. Understanding the difference between assets and liabilities and knowing your net worth is the key to stepping out of the rat race and towards financial freedom.